Hello and welcome to the Thursday, January 16th, 2020 edition of Tesla Daily, unofficial Tesla podcast. My name is Rob Maurer. Today we are talking about Adam Jonas of Morgan Stanley's most recent note on Tesla that came out before market open today. And then we also have some comments from Volkswagen CEO to talk about as well. So looking at Tesla stock on the day, actually a pretty impressive recovery throughout the day. It began the morning in the 490s below $500 per share, but finished the day down just 1% at $513.49. But that did compare to the NASDAQ, which was up 1.1%, which is a pretty big move for an index. So I do believe that the Jonas note did hurt the stock today, as well as the report that we had yesterday about California registrations being down. Talked about that yesterday, so I won't go through that again. But I did want to go through the Jonas report today, and it's not necessarily because I care too much about what any individual analyst has to say, but I do think it's important to understand because the market does seem to react to them, and it is a good jumping off point for discussion. Looking at Jonas's note, this one's a little bit weird because in this case, they actually did increase their price target by almost 50% from $250 per share previously to $360 per share. But they also downgraded, meaning they changed their rating from equal weight to underweight. A mixed report that shows an improved outlook for Tesla, but not compared to the recent price appreciation that we have seen. So Morgan Stanley says, quote, "We downgrade Tesla shares to underweight from equal weight based on number 1, valuation, number 2, unfavorable risk reward, and number 3, risks to the long-term Chinese business that may not be fully appreciated by the market." End quote. We'll go through the details behind this price target and this rating. I know the price targets get a lot of attention, but after my conversation with Alex Potter, I've become more interested in the actual notes behind the price target because I don't think that analysts necessarily care too much exactly where that price target is falling, and I don't think their clients necessarily do either. I think it's more about the underlying assumptions and the forecasting and methodology behind the scenes in the note. So we'll go through some of those details here. But first, Adam Jonas does talk about the reasons he sees behind the recent rise in Tesla stock and valuation. So I think this is interesting because a few days ago I did the episode about the top 10 reasons that Tesla stock price has increased. So I was curious to see how Adam Jonas's reasons compared to what I had. So he had reason number 1 as, quote, "stronger than expected global demand for Tesla vehicles, which has created more optimism around the long-term margin profile of the business." End quote. So reason number 1 there, the two things I always talk about, demand and profitability. Reason number 2, he says, quote, "China announcements that show Tesla's expansion into the world's largest electric vehicle market is progressing well from a demand and margin perspective." End quote. Number 3, supportive incentive developments, i.e. the potential, however small, for extended subsidies in the US. And number 4, positive sentiment around product expansion. End quote. Personally, I do favor my own list. I mean, I obviously am biased towards myself, but he doesn't talk about Cybertruck. He doesn't talk about competition not really showing up. He doesn't talk about the S&P 500 inclusion, short covering, any of these things that have been left out of these reasons here. I do think these are all legitimate reasons, but I don't think they cover the entirety of the shift that we have seen in Tesla over the last 3 to 6 months. All right, so looking at the forecast and the price targets, we know that Morgan Stanley splits their price targets up into the bull case, base case, and bear case, which previously led to a lot of attention for Adam Jonas when he had a range on Tesla stock from $10 to $500. So that range, even though it was a big range, ended up being not quite correct. But now the bull case has moved up to $650 and the bear case has moved down to $115. And then again, the base case at $360 as we talked about. So today I mostly want to focus on the base case because I think that's really where the essence of the discussion lies in the note. So looking quickly at how Adam Jonas is forecasting to get to this base case, he has 2020 at just under 500,000 vehicles with an 18.5% gross margin, building up by basically 150 to 200,000 vehicles per year, pretty consistently all the way through 2030 to get to a final 2030 number of 2 million vehicles at about a 24.5% total company gross margin. Right off the bat, this tends to look pretty conservative. This would be an average increase per year of about 146,000 vehicles. Tesla has already accomplished that feat once. In 2018, production increased by about 150,000 vehicles over 2017, obviously with the ramp up of the Model 3. I suppose you could make the argument that that production ramp up should have gone smoother and that production increase should have been spread over 2 years, falling more into 2017 than into 2018. But Tesla has already accomplished better results than what this average is for the next decade, and I don't think Tesla's going to slow down in their ambitions. Even this year, with no new vehicle coming out, Tesla increased production by about 110,000 vehicles. So with Gigafactory Shanghai coming online, with Model Y ramping up, we should easily exceed these numbers. I think that's especially the case the further and further out you look. So for example, 2027 is the first year that Adam Jonas has Tesla crossing 1.5 million vehicle deliveries. Well, we already know that Gigafactory Shanghai and Gigafactory Berlin and Fremont in concert should be able to produce 1.5 million vehicles. And it's not going to take 7 years for those gigafactories to get up to that scale. 7 years back from this point in time, when Gigafactory 1 is already pretty much at scale, we would have been in 2013 when Tesla was first launching the Model S and the Gigafactory wasn't even a thing yet. So this is extremely conservative and doesn't factor any improvement in Tesla's ability to ramp up products from what we've already seen over the last couple of years. So then you're really coming back to, okay, this is probably a question of demand. Interestingly, Jonas says that Morgan Stanley is forecasting 24% of all vehicle sales to be electric vehicles in 2030. So they say, quote, at roughly 100 million annual units, that is a 24 million unit EV addressable market. Our base case forecast implies that Tesla achieves roughly 8% of the EV market by that time and greater than 10% of EV revenue, end quote. So it's not clear exactly how much this is influencing their forecast for Tesla, but I think this is the wrong way to look at it. And rather, I would look at the entire addressable market rather than assuming there's some fixed number of EVs that are going to be sold and then applying a market share to Tesla for that. Because if we look at 2 million units out of 100 million annually, that has Tesla at a 2% market share in 2030. That seems extremely unlikely. Even if we do assume there's an EV market and that EV market is 24%, 8% of that market seems low. That's assuming that Tesla's competition makes significant strides on Tesla over the next decade. So I think overall a highly conservative forecast, and I think it'll be fun to look back at in 2025 when Tesla's at 2 million vehicles per year, 5 years ahead of this schedule. A couple other things that stuck out to me in the note. This quote is about Tesla's competition and their growth rates versus Tesla. Jonas says under this forecast, quote, Tesla grows 3 times faster than premium German OEMs, but trades at 5 to 6 times the valuation. We estimate average top-line growth for Tesla from 2021 through 2030 at just over 12% versus premium luxury auto growth rates of approximately 4%, end quote. I'm not sure there's another quote in this that demonstrates how differently I see things than Jonas does. He's saying 4% growth for German OEMs, and then using that to say that Tesla's valuation should be 5 to 6 times the valuation, not on a market cap basis, but on a earnings ratio basis of those OEMs. First of all, I cannot fathom German OEMs growing at 4% for a decade. That's a lot of growth that I'm not sure where it would come from. Maybe on a unit basis for these premium guys, they could, dilute their brand and push down market, which would maybe help unit sales, but I believe this is talking about revenue. So I just cannot see that happening. The last thing here that I thought was interesting, Jonas kind of laid out 3 different cases that could be extremely bullish even beyond his bull case for Tesla. And one of them was about being a supplier for the industry, saying, quote, if Tesla were to supply EV batteries and powertrains with a 5% global market share and a content per unit value of $12,000, at a 15% net income margin, that would yield more than $50 billion of revenues and $8 billion of profit. At a 10x multiple, this implies more than $400 per share of value per Tesla share today, end quote. So I've never been on this whole Tesla's going to become a supplier for the industry thing. If you look at what Tesla's done over time, they've become extremely vertically integrated. There's a great reason for that. It means lower cost. Tesla can then cut the margin out at each of those different layers and pass those cost savings on to the final consumer, allowing them to sell more units. If Tesla goes the supplier route, then they're just going and adding that cost back in. Maybe additional scale could make up for that, but if Tesla has that additional battery and powertrain scale, why not just use those batteries and powertrains themselves? There is an extremely, extremely small chance that there's going to be some other differentiating factor from some other OEM that Tesla can't replicate or is already offering themselves that would make a situation like this make sense. I'll be extremely surprised if there's ever just a straight up supplier agreement that doesn't involve some sort of ownership or partnership. You might argue that this sort of concept might allow Tesla to get more electric vehicles on the road more quickly, but honestly, I doubt it, and I think Elon Musk doubts it. Nobody else is going to be willing or able to move as quickly as Tesla does. But hey, there's your bull case right there, Adam Jonas. If you think that Tesla can build enough batteries and powertrains to supply 5% of the market, well, then Tesla can take 5% of the market, put that in, and see what you get. Speaking of speed, the next topic I wanted to discuss today is some comments that were made by VW CEO Herbert Diess at a global VW board meeting today. Reuters is reporting that Diess openly said that VW needs to accelerate the overhaul of its business to avoid becoming another Nokia, saying, quote, "The big question is, are we fast enough? If we continue at our current speed, it is going to be very tough," end quote. And in regards to transitioning powertrains and emissions and things of these sorts, he said, quote, "In summary, this is probably the most difficult challenge Volkswagen has ever faced," end quote. From these comments and comments that Diess has made in the past, he does seem to understand it, but then at the same time, you also have Reuters saying, quote, "VW also needs to focus more on profit and less on volumes," he said, end quote. Now, this may mean on specific product lines. He actually mentioned Bentley, saying that he would prefer Bentley did 5,000 units at a 20% margin than what they actually did, which I guess was 10,000 units at a 0% margin, which is absolutely shocking for a vehicle in that price tier. But if we're talking about overall organizational profitability, rather than just specific product lines, now is not the time to be looking to increase profitability. Now is the time to be trying to stay alive and trying to invest in getting through this transition. VW obviously doing some of that by force with the Dieselgate scandal. But seeing comments like that just makes me more and more sure that no one is going to be able to go through the pain that Tesla went through to be able to compete with where Tesla's at today, much less where Tesla's going in the future. So that will do it for me for today. As always, thank you for listening. I'd also encourage you to follow me on Twitter at Tesla Podcast. And if you want to support the podcast, you can find those details at patreon.com/Tesla Daily Podcast. Don't forget to subscribe, and I'll see you tomorrow for the Friday, January 17th episode of Tesla Daily. Thank you.